in Orlando, Florida. We're both in the Central Florida area. I used to be a mechanic actually before this, and I used to work in the automotive industry in general, in a couple of different fields, wearing a few different hats. But so I'm used to fixing problems. I'm used to, taking your issues and making them work and giving you the dream ride, right? Making everything go away. So that's kind of what I do. I am pretty passionate about getting people into property as a whole. So I definitely enjoy being in this industry a lot more than automotive. So just real quick before we get into the real meat and potatoes of what's going on tonight, I just want to quick, kind of gauge the room a little bit, see how everybody's feeling about what's holding you back in particular from buying right now. If you're on the fence a little bit, if you're thinking about it, if you have some hesitations, I'd like you to just kind of keep those thoughts and make sure that you can put those in the chat down at the bottom. So what are some burning issues, something that's keeping you from stepping into the market right now? Okay. I see interest rate concerns. Okay, I see market concerns. Sure. Pretty common stuff. Down payment concerns, yeah. Sure. Nothing crazy right now. Okay. All right. Yeah, we'll get to a lot of those concerns in a second. Let me just read off a couple here. So you're wondering how much you need to put down on a property. That is really going to sort of depend on a lot of different things. I don't want to get too much into Q&A right now because we have that at the end, but I usually recommend people 3 to 10% of whatever property you're looking at or whatever price range you're looking at is a good rule of thumb. But we'll get to that at the end. Just hold all those questions for right now. So here's how the typical home buying process kind of works. Or at least how most people kind of go about it, right? You get your realtor, you get pre-approved, you go house hunting, you fall in love with a property that's in your price range, so you make an offer. You don't want to pay full price if you don't have to. You go into contract after a little bit of negotiation, talking with Kimberly and myself will advocate on your behalf to get your offer accepted. Complete inspections and appraisal, you'll finalize the loan with us, and then we close on your home. And then you move in. That's right. Usually how people typically do it.
Yeah,
and this conventional HA or VA loan.
In this process, it works for a lot of people. It does, and the process that we're going to talk about today is not necessarily completely different from this. The only part that we really would have to kind of tweak is that get pre-approved part, right? Like you still will need to potentially talk to someone about getting pre-approved for a loan. Right? There are still documents you need to turn in, but we're not talking about your traditional vanilla options. We're not talking about your typical convention loans today. We're not talking about your typical FHA loan. So we're going to get into some things that maybe you didn't think of or didn't even know about.
Exactly right. Yeah, this, like we said kind of at the beginning, this traditional route obviously does work for the vast majority of people. I think conventional loans and things like that account for about 70% of market share for home purchases right now. So most people are able to get into property with conventional means, but that doesn't mean there isn't still a significant chunk of the population that does need something a little bit more creative, a little bit more flexible. Again, an example of this would be somebody who perhaps owns a business and they write off a lot of the income that they have just to, reduce their tax liability. On paper, they don't make a lot of money. We can't qualify them for a traditional loan a lot of the times, but we know they make money. They're a business owner. They've been running this business for who knows how long. Well, we know how long because we're giving them a loan, of course. But at any rate, traditional means might not always work for somebody like that. Additionally, somebody who maybe is retired, has a pension, they have money coming in, but it's not W-2 income. They don't have a job to prove. It makes it a little bit harder for the banks to want to go in on a loan with them. So there are certain categories of people that do need something a little bit more flexible than this traditional route. So that's sort of where creative financing comes in. In short, creative financing is alternative ways to qualify for a mortgage when traditional documentation or credit guidelines don't really tell your full story. Kind of like we were saying, you might have some other explanation as to why you're not making all the money all the time. Perhaps, again, if you're commission, for instance, somebody who works a perfectly normal job, but they just get paid commission, they don't have a steady income, right? That makes it a little bit harder to get them a loan through traditional means, but that's something that can be solved with creative financing. These are legitimate lender approved programs. They're not any kind of risky loopholes or, third party, loan sharks or anything like that. These are people who have been vetted, approved, and know exactly what they're doing. So let's get into it. So we got 5 creative ways to purchase a home. First one we're going to talk about tonight is going to be bank statement loans. This is basically going to apply to anybody who has cash on hand, who does have potentially cash coming in, if maybe not on a super regular basis. Again, think somebody commissioned, somebody who's who again a business owner who reduces a lot of their tax liability that way. Again, like a retiree. Again, this particular one will work for all 3 of those types of people. So how it works is we will qualify you using 12 to 24 months of deposits. As opposed to your W-2, we just use your bank statements. We will take that bank statement, the total amount that you have saved up, multiply that by an aggregate amount. Usually it's 60 to 80%, depending on the lender that we end up going with. And then that number that it spits out is the qualifying income that we use to get you qualified for your loan. No W-2 required, so you don't have to have that steady, the 2 years of tax return kind of setup that most people are kind of dreading a lot of times. Or if somebody has if they move around a lot with their job, perhaps that might be another situation. It's more flexible. That does come at a premium, so you will pay slightly higher interest rates. Not anything to worry about because you still can refinance that loan in about usually 6 months is the seasoning period. And it's good for owner-occupied or investment purchases. So it doesn't have to even necessarily be a primary residence. You could use bank statement loans to purchase an investment property. Again, if you're somebody who is in the situation where this might be necessary, you could be a little bit more investment savvy. So it might be something to consider if you're trying to get into a property and can't qualify for a traditional loan. Leaning more into that idea of investment loans is a DSCR loan, which is a loan that is basically qualifying you based off of the income that property would produce, as opposed to your own personal income. So, for example, if the mortgage on your loan would have been, let's just keep it easy, $1,000. Good luck. Say it's $1,000, and you can rent out that property for say $1,200. $1,100, you qualify. That's it. You're good. The rent covers the mortgage. Done deal. That's all we need, more or less. There's a few little things, credit and things like that, and we need to know more about experience and things as well. But this is a very good option for somebody who does want to expand their rental portfolio. The biggest qualifying factor is, does the property cash flow? Common question that I get for these kinds of loans is, does the property need to already have a tenant in place at the time of purchase? No, it does not. It can be just market rents, speculative, whatever you can rent it for is what we would qualify it on. It does not need to have a tenant already in place currently paying that rent to qualify for a loan like this. Like I said, it's good for rental properties. Typically, you want to see it have more than or equal to 1.2 times what the mortgage payment is. Again, in the example, $1,000 mortgage payment, at least $1,200 in rent is what we're kind of looking for. That rule has changed actually quite a bit in recent times, just because of how things are going in the market. It's a lot harder to kind of hit this rule, this particular stipulation. So that actually has come down for a lot of lenders. I've seen as low as actually even 0.9. So it doesn't even have to fully cover the mortgage. You could be underwater a little bit and still qualify for the property, which can get you some good equity. Food for thought. Benefit is they do have fast closing, and there's no tax returns required. And again, we're not qualifying you based off of your own personal income either. So definitely a good option for somebody who is a little bit more investment minded. Then we have asset-based loans, very similar to bank statement loans, only instead of just your bank statements, we're going off of anything that's considered an asset. So we're talking 401ks, we're talking retirement accounts, we're talking jewelry, cars, houses, businesses, credit cards, anything that's really of value that can be considered an asset, not a liability, or turned liquid fairly quickly, we can use in an asset-based loan. And again, that same kind of idea, we take the total amount that everything is worth, divide it by a number, spits out another number, we use that to give you your loan. in layman's terms. That's I try to keep it as simple as I can. I don't want to lose people in the minutia of how these things are actually specifically done. This is not particularly a loan option that we can really sell to anybody or provide you with. House hacking is more of a it's more of a technique really than anything else. It's the
Yeah.
act of do you want to go into this one a little bit,
Oh
Kimberly?
yeah, sure. So, house hacking, like you said, it's not really a loan product, but it is a good technique to use. So essentially, what you're doing is buying a multifamily property. You live in one unit and you rent out the others. Now, this can really offset or even cover your mortgage depending on, how much you're purchasing for and everything. So with this option, this is really great if you find yourself needing or wanting to buy a house that's a little more expensive than what you would qualify for on your own, because the rental income that you get now becomes part of your income. And they can look at that and say, you know what, maybe by yourself you could only qualify for 250,000, but perhaps now with that rental income you can actually purchase a home for 315,000, for example. So it's really
Exactly.
helpful for you if you're in that situation, and it also puts you in a situation where you become a homeowner and an investor at the same time. So you can kind of cash flow. I mean, if you really think about it, probably one of your most expensive bills that you have is your housing bill, whether it's renting or paying a mortgage. That probably takes
Absolutely.
up most of your money. So imagine being in a situation where you don't have to worry about that. Imagine that
Yeah.
$2,000 back in your pocket. Imagine what you could do with that. Okay. So
Imagine having an extra $300-400 a month on top of having your rent paid for.
absolutely. I'm sure for many people it'd be life changing. So um,
Absolutely.
if you haven't considered this, definitely consider this as an option. You can use an FHA loan to actually purchase these duplexes and triplexes and quadplexes. It cannot be more than a 4 unit, though. It needs to be two,
Yes.
three, or four. Cannot go over that. And you do have to live in at least one of those units. But again, it's a great option as a first home. I know a lot of people want to skip straight to a single family home, but if we're talking
Hmm.
about money wise, this is actually a smarter move for you.
Yeah. 100%. This is a much smarter building block because again, like you said, it's essentially two houses for the price of one. If you really think about it, if you're buying a duplex, triplex, or quadplex, and you can use DSCR loan as well to purchase a duplex, triplex, or quadplex, which is probably a perfect scenario, honestly. That being said, FHA loans do also qualify for those. It might just be a little bit FHA can be a little bit stringent with the requirements of the property, so it would have to be something that's a little bit more done up. But at any rate, I do want to touch on a point that you had actually mentioned earlier. It doesn't actually even for house hacking. You depending on your situation, you could just house hack a single family too if you want to just rent out the other rooms. You know,
True.
that could be a potential avenue as well. It depends on your personal living situation and if you're even comfortable with sharing a space like
Right.
that with somebody. But if you have some friends that need some cheap, affordable living and you want to split your rents into a couple different ways amongst them,
Yes.
you know, it's
Absolutely.
it's definitely it could definitely be a good way to get your foot in the door as like as Kimberly said, both a
Yeah.
homeowner and an investor at the same time. You get your living expenses subsidized and you make a little bit of money on the side as well.
Yeah.
So
And
definitely not something to overlook house hacking.
and with that in mind, house hacking, but not necessarily purchasing a duplex. I've seen quite a bit in in the central Florida area,
Oh
where
yeah.
two things: either you have homes that kind of have a like a mother-in-law suite built in.
Yes.
So
Yeah,
if
yeah, yeah.
you
ADUs.
find that, that's perfect because usually that is a bedroom, bathroom, and sometimes even a kitchenette built
Yeah, there's a
into
lot
the
of times a
home.
little kitchenette kind of area built in there.
Yep.
No, those if you find a property with an ADU, additional dwelling unit, definitely can be a good house
Yeah.
hack opportunity for sure. I've
Yes,
also
I've seen
seen
a lot of
actually,
those. Like in the
yeah,
backyard, they just have a whole separate home or on the side.
I've seen people also if you don't need your garage, I have seen people convert their garages into additional dwelling units, ADUs also.
Hmm.
That could potentially be a route if you purchase a property and step into some instant equity.
Yeah,
You buy a house that's worth, 200,000, you buy it for 150, you got 50,000 worth of equity, you can put that into renovation, like an
absolutely.
ADU, rent it out, make
Absolutely.
some money,
And I've seen
you
it
know.
done really tastefully with just a two-car garage, regular two-car
Yeah,
garage. They turned it into a two-bedroom, one-bathroom unit with a kitchen. I mean, was it like humongous? No, but there is a market for that kind of home. You just have to make sure that the home that you're purchasing will allow for those kinds of renovations.
yes.
I've seen people try
Zoning.
to do it
Check your
in,
zoning. Get your permits.
and not to
Make sure you
mention if
check
there's
out.
an HOA, huh,
Yes.
make
Oh, yeah, yeah, yeah.
sure it
Definitely
is within the bylaws.
make sure you're good there. But it is a strategy if
Yes.
that's available to you. We could have a whole other webinar just on house hacking. I feel like,
Yeah,
to be
we could.
honest,
We have to look at, maybe we
it's a
should.
great strategy. If you really like it in this economy, it's great. Um. All right. And then I believe this is actually going to be the last one that we're going to have for you here tonight. It's going to be seller or builder financing. Um,
Absolutely.
so this is kind of seller financing is kind of hard to beat. As a lender, it's basically when the person who owns the home is acting as their own bank. They'll give you the home based off of this interest rate for this long of a term, et cetera, et cetera.
Hmm.
Um,
Yeah.
that's completely out of my realm. That's 100% for the homeowner, at the homeowner's discretion. A lot of the times you'll see that for sale by owner kind of situation, maybe where that might arise. A lot of the times that is probably going to be a better option if you can even find it, just because it's
Yeah.
kind of hard. At the point, most people just want their money and they're done. Most people
Yeah.
can't afford to quote you $300,000 house. Pay me
Right.
later for this
Right.
insane ask. Most people aren't in that position, but if you find it, that's probably going to be your cheapest option in a lot of cases because they're not going to charge you the 5 or 6% interest that you're going to get charged in the market. Because if they're willing to do that, it's probably because they're in a situation and they need somebody else to take care of the property, whatever the situation is. Not easy to find, but definitely worth it if you can. A little bit
Absolutely.
easier to find would be a new builder with some builder incentives.
Oh, yes.
um,
We've got tons and tons and tons of new build, new construction communities here in Central Florida. I know there are places around the country where people are saying there's not enough inventory. Well, let me tell you, there may not be as much resale inventory, but there is a lot of new construction here in Central Florida, and they are sometimes they're practically giving the houses away right now. Okay, they're
yes.
like giving you $15,000 to $20,000 in closing costs. They're willing to buy down your rate for you. So instead of paying 7%, they're like, hey, you know what? We'll give this to you for 4.95. And I know that has some people going, oh, right. It should, because that is a much better rate than what you would typically see right now in the market. Some of them are doing things as low as 3 point something, but be careful if you see that, because more likely than not, your rate is going to go up in a couple of years, and that could put you in a position where you can no longer afford it. Do not let them twist you into getting an adjustable rate mortgage, because
No.
you don't want to find yourself in 5 years, for example, saying, oh, well, I had planned on moving out, but life happened and I need to stay, but I can't afford this home. So builders have lots of incentives, and a lot of times they will buy down the rate and give you money on the closing costs, but it's best if you still work with a realtor, because their representatives work for the builder. If you have a realtor, that realtor is working in your interest, not the builder's interest. So just keep that in mind. But if you do need some extra funds, you want to get into a home, but you need a little more flexibility with price, cost. You don't quite have all of the money up front. This is a potential option for you.
Definitely, definitely. And I would have to caveat that for a split second. I actually did make, if nobody's following me on LinkedIn, please do so. I made a post about this actually on LinkedIn about builder financing, and why so many, I should say, certain lenders or builders are starting to have a lot more of their loans go underwater.
Mm-hmm.
So essentially, what's going on in that industry, just to kind of have a brief overview of it, is a lot of those really really low interest rates are part of what's called a, oh my goodness, what was the term? It was a builder rate buy down. It's basically the between the builder and whoever's financing them, the financer gave the builder a lot of money to artificially lower the interest rates for a temporary amount of time to incentivize people to buy.
All right, temporary.
Once that's, it's temporary, and that's the caveat, that's the key
Oh.
word, right? Is that it's temporary. It's maybe 1, 2, 3 years, and then it's done, and then your rates are going to go right back to where they were, which in some people's cases might be a little bit of a pinch. So what I would say is definitely, definitely, if you get an offer from a builder, take it to a second, maybe even a third party, and just have another opinion put on it.
Mm-hmm.
Doesn't necessarily have to be me, although I would love for it to be. Just get a second opinion from somebody that you trust, because if it seems too good to be true, it kind of can be in a lot of cases. These builders aren't doing these kinds of things out of the kindness of their heart. They're trying to make money, and they're trying to get their inventory sold. Second
Yes.
point that I want to mention about builder financing is because it's a new construction, and I believe we had talked about this the last time in our first webinar about the buying new versus buying new versus used.
Mm-hmm.
When you buy new, you're buying at the top of the market. You're not buying a house that has any equity potential in it, because the builders built it specifically to make money at the top of the market. That's what you're buying. So in this instance, what can happen sometimes, and that doesn't always happen, but the market can change. The house doesn't necessarily appraise for what it's worth, and now you're kind of in a negative equity position. Which, if you're going to be in the house for the long term, might not be the scariest thing, but if you're unsure about where you're going to be in the next, 2, 3, 4, 5 years, that's definitely something to consider. Or if you just need to borrow money against your equity, that might be something to consider. Is when you're buying brand new with those incentives, there is the potential to go upside down in your equity position.
Absolutely. There are a lot of things to watch for when buying new construction, because we also talked about the tax issue, right? The issue with the taxes going way, way up in your first year, and then your escrow account being short and your monthly payment going up. I mean, mine went up almost $1,000. Like, that was absolutely crazy. It was something dollars. Yeah. And that was with me putting a lump sum on. So when it comes to buying new construction, definitely talk to some other professionals. Do not just sign immediately, because there are quite a few
don't just take their word for
it. Yeah.
It's not all doom and gloom with builder financing. We don't want to put that out there, but it is definitely something that you have to be careful of.
Yes.
Because we also don't want to see anybody get screwed, essentially.
Right.
Because it does happen. If you look in the news, I don't know if I can legally name names, but if you look in the news, there are a couple of big builders that are in some pretty hot water, because of the loans that they've been underwriting. So it's definitely something to just get a second opinion on. If you see a rate that's too good to be true, it's so much lower than market value, then okay, that's probably a red flag. If they're just giving you $20,000-$30,000 down, take a look at the final price of the house. Did that change?
Oh, I was gonna say, yeah, usually with the extra incentives, the price of the house is more. So, and I talked to a lot of these new construction consultants and everything. I talked to them pretty frequently. And basically what they tell me is you're going to get two options. You're either going to get a really low price compared to some of the other ones, but everything else is normal, like your rate is going to be normal and everything else. They're not really going to give you a bunch of closing costs and stuff because you're getting the
Sure.
price itself low.
Yes.
Or you're going to get it at regular price, which is them making a profit, and you'll get the other things on top of that. Now, it's not that one is better than the other. It just really depends on your situation, because
Mm-hmm.
sometimes having the price of the house be more or higher is not going to affect your month to month payment as much as you think. Your interest rate has a huge effect on that. So it really depends on your situation. This is why we keep
Exactly.
saying talk to a professional. Don't just look at it and sign it. Don't be confused or be having questions and still sign, because those questions that you had could be, the deciding factor whether or not this is actually a good option for you. And we
Exactly.
don't want you locked into something that's going to put you in a bad situation financially. So there's plenty of good that can come from it. Just talk to
100%.
someone about your situation.
Like, let us use our licenses and expertise to help
Yeah,
you get into a good situation.
absolutely.
We didn't get licensed and educated to not help people.
Yes,
So if you
exactly.
do go to a new builder, just let us know. Let us take a look at the deal.
Yeah.
If
And
it's
by the
something that's good
way,
for you, yeah.
you can absolutely buy a new construction home and not use their loan officers. You don't have to actually
I
use them.
was gonna mention that actually.
So
Yeah, you can
just so
definitely,
you
you
know.
don't have to use the new builders in-house financing by any means. Like you
Yeah.
can definitely come in. It's like going to buy a car. You don't have to buy your car with their in-house financing. And usually it's better if you don't, to be honest. Like if you've
You
ever
just
bought a
won't
new
get the
car, a lot of
incentives.
times, yeah, just go to your local credit union or the bank that you are already with and get a loan from there. It'll
Yeah.
usually be cheaper than if you go directly to, the place and try to do it. But
Yeah,
get a
that's
second opinion.
another thing.
Always, always, always get a second opinion.
Yeah. Yeah.
All right, what to expect and how to prepare. All right, so like Miss Kimberly was saying earlier, even though these are slightly, these are more flexible and more creative options, there is still a process. There is still an approval process. We do still need documentation. It's just more flexible. We can kind of use a little bit of this, a little bit of that, a looser explanation for why money wasn't in on February, but it is in March. Banks won't usually like that kind of thing, whereas we can kind of understand that you're a business owner or you didn't have a really so hot month selling that month. These are things that we can get around, but there is still documentation required, so don't think it's all just easy street because right. We are, as fiduciaries, we do have a responsibility to you as a consumer to make sure that you can reasonably afford the loan that you're applying for, as well as you can reasonably pay it back. Not only that can you afford it, but can you pay it back for the next 30, however long this loan is going to be for. So we do need to verify everything that, one, you're saying, and two, that is on paper, even if you didn't tell us. If there's something that you forgot, we need to know why that's there. Did you miss a credit card statement? What happened that month? That kind of thing. So trust but verify. Excuse me. But at the end of the day, like, the more you're prepared, the more that you talk with us about what you want to do, what your goals are, the earlier that we can organize, and the smoother everything becomes when it's time to actually make a decision. Talk to us early. Hey, this is what I want to do. We can talk about options, talk about documents, talk about what else we would need to make things go smoothly. And then when you make your final decision, we already have every step of the way planned out, and then we just have to execute. We're not circling around trying to find this, trying to find that. We know exactly what's happening, and that's kind of what we offer to anybody that wants to work with us. Is just constant communication and a smooth process. What can get better than that?
I will say, if you are an entrepreneur, you're self-employed, one document that you should work on having, if you have not already done so, is a profit and loss sheet.
Yes.
That will help you tremendously in in filing your taxes and in
Yes.
being prepared to go ahead and get approved for different kinds of loans. That one sheet right there, you need it to run your business like a business anyway. It's good to document. If you need help with that kind of thing, absolutely, text us, call us, whatever, we can help you, um,
Absolutely.
so that you can get that going, so that you're prepared for what you want to do for your goals.
100%. Get us in contact with your financial person. If you have a CPA that you work with, let us talk to them. We can
Absolutely.
probably they're gonna know a lot more of what's going on here than you might. No offense to you, but we're the nerds that like all this kind of math stuff. We're the ones who are educated in all this. So if you are apprehensive about the process, let us talk to the person that you talk to about your money, and let them kind of ease your mind about what's going on. So we're gonna get into our Q&A here real quick tonight. If y'all have some questions and are kind of tired of hearing us talk, we will get into that right now. So here we go. Live Q&A. Drop your questions in the chat. All right. Give y'all a few minutes to kind of get that going. I wish we had some background music. We could have the Jeopardy music going. How funny would that be?
I know. You know what? Next time I'll have to like play around with Rome a little more.
Yeah, yeah. Or we could just
Figure that.
have the YouTube tab opened up on the side or something.
Yeah, make sure the sound is coming through. We'll figure that out for next time. I like background music.
It's nice, yeah. It would have been nice to have a little bit of background music today. I didn't even actually even really think about that until now. Um, all right. So I think that just for the sake of time, we will probably start pulling some of these questions and start wrapping it up here. So I have, what's the minimum down payment for a DSCR loan? Good question. It's really going to sort of depend on the deal and on the lender and on the borrower. So it depends on a few things. Typically, just general rule of thumb, because it is an investment loan, it is going to be a little bit more cash forward than, say, a conventional loan, but you're still not going to have to really come out of pocket for any more than a traditional loan. It's just a lot less flexible in that down payment requirement. So for a DSCR, there's no low down payment option really available, no FHA, DSCR, or down payment assistance available. You are going to be coming out of pocket for about 15 to 20% usually, with some lenders going higher, 20 to 35% of the purchase price. So that's usually what you're going to be looking at for a DSCR loan, again, because it is so investment forward. That being said, because you're already purchasing the property with a 20% equity position, you're 20% down. There is no mortgage insurance necessary on a property that's purchased with DSCR in that way. So that's going to be helpful for your cash flow as an investor. And yeah, that's I hope that answers your question. Let's see. What is our next question? Can you use a creative loan for short-term rentals? Yes. Yes, you can. Yeah, that's a short and sweet of it. Yeah, you totally can. It's going to depend on the lender that we end up going for with your loan in particular. They are going to have certain overlays. Some might not like short-term rentals. Some might be okay with short-term rentals. What I would say is particularly in Florida, with how we in this state kind of treat short-term rentals and how that whole model seems to be kind of under attack in recent years. The Airbnbs and things have just been getting a lot more strict. It might be a little bit more difficult to use creative financing for something like a short-term rental, but is definitely not impossible. I have seen a couple of lenders that are totally okay with still taking on loans for Airbnbs and things like that. So short answer, yes, you can use creative loans for short-term rentals.
Oh, before you move on from that, here's something that someone might be wondering. What about an FHA loan for a short term rental, right? Like that could be a problem, right? Because if you're not living in the home, then you can't use FHA.
Yeah.
But
Let's see. Can we use an FHA loan for a short-term rental? I want to say yes, right? Like I want to say you could. There's nothing stopping you from securing an FHA loan and then subsequently renting out your own property. However,
But
I'm pretty
technically,
certain, but
legally,
technically, yeah, like we all have free will. Yeah, you could, but like no, you're not. You're not really supposed to be buying rental properties really in general with FHA loans. That loan product is designed specifically for primary residences. I think you can buy secondary homes with it, but it's pretty strict against using FHA loans for investment properties in general. And that also is kind of has to do with the fact that you're getting away with 3.5% down. That's investment loans generally require a little bit more skin in the game than that. Just because if you are a newer investor and everybody is a new investor and they're all taking out 3.5% loans and half of them default, that's a big problem. So we kind of need somebody to be a little bit more seasoned, a little bit more experienced, and have a little bit more money at risk to make sure that they're going to actually, follow through with making sure that property is profitable. So, no, you cannot use FHA loans to purchase investment property, unfortunately. What you do in your own free will is completely, not my responsibility at that
but
point.
Legally, you're
Yes.
required to live on the
No,
property.
you are required to live in the property if it is an FHA property. 100%.
Yeah. Now, if you
Um,
live there and you want to rent out part of it, then that's fine. That's different. But you do need to
yes.
live there.
Yes, 100%. You can totally house hack an FHA property, 100%.
Yeah.
Like we were saying earlier, you can use FHA for duplex, triplex, quadplex. You can buy a single family and rent out the other rooms. You can convert the garage. You can build an ADU. You can do all kinds of crazy stuff that way with an FHA, and that's not a problem. But the minute
as you
you
live
stop
there.
living there, that's the problem.
Yeah.
It has to stay as a residence. So house hacking is 100% viable option if you want to go the FHA route. And you can still use your 3.5% down option for that too. And segueing off of that, I can actually get you into an FHA with 0% down. Ask me how. Last question I think we'll take for tonight, and then we will wrap it up. Do these loans have prepayment penalties? Yes, most of them are going to have prepayment penalties because they are kind of taking on what is perceived as a higher risk in lending you money because you have this profile. Maybe you're not making money on a consistent basis. You have a lot of money written off. You don't have the highest provable income, whatever the case may be. They do want you to be in these properties for longer periods of time without paying them off, so that obviously they can recoup the amount of money that would be what they consider necessary to even enter the deal in the first place. If they give you the money and then you immediately turn around and pay them back, they didn't make any money. They just took on all the risk for no reason. That's not what really they're interested in doing. The bank is still the bank at the end of the day, no matter how creative or flexible their terms might be. At the end of the day, yeah, they're some. I will have to caveat that some don't have prepayment penalties, but the majority of them do. So I'll just say that yes, most of these products are going to have prepayment penalties. If there isn't, then I will absolutely let you know that because that's important. But in general, if you're looking at these kinds of things, it's important to ask that. But keep in mind that most likely it will come with some form of prepayment penalty. For those that don't know, maybe what a prepayment penalty is. It's a penalty that you would accrue for paying off your property earlier than what your amortized day is. So if you take out a 30-year mortgage and you pay it off in 5, possibility for a prepayment penalty in that instance.
The penalty being money.
Yes, it's
the penalty being money.
Yeah, it's a fee. So it's money. So that's what that is. If you want to avoid that, then that's definitely something that we would have to talk about in our consultation. How we can avoid prepayment penalties, what lenders we would have to go with in particular to avoid that from happening. I did actually have a conversation recently with one that doesn't have prepayment penalties, but for another day. All right, cool. I think that is going to wrap it up for our Q&A here. Lots of really, really interesting questions. I'm glad we were able to kind of get to everybody. Like we were saying earlier, if you want a chance to kind of sit one-on-one with either Kimberly or myself or both of us at the same time, this is going to be the best way to get into contact with either of us. We got all of our phone number, email, socials, all that good stuff is going to be right here. So go ahead and take a look, screenshot it, whatever you got to do to make sure you can get in contact with us. And besides that, yeah, that's it. That's everything. We are all done. I hope everybody found this very informative and got something out of it, at least a little bit, and is willing to come back to our next one because there will be more.
Absolutely. Honestly, we may need to do a part 2 of this because while we were talking, we were coming up with more ideas.
I was literally thinking that, yeah, like
so
that house hacking one, I think is I think that might be gold. Like that's a whole thing in and of itself. Like,
right, different ways to house hack.
Yeah. No, that's a whole webinar right there. Definitely.
All right.
Cool.
So
Let's
thanks
we'll
for watching, everybody. We look forward to seeing you at the next one.
Absolutely. Everybody have a good night. Be safe.